Is this the end of the tech industry? Keep watching to find out. Now guys, we do not own any shares in SVB or Silicon Valley Bank, and we also don't own any shares where the company deposited money into SVB. Now, of course, as usual, what we say is purely educational, right? It's not financial advice. According to experts, in 2023, there's a 60 to 90% chance of recession, and I'm sure you want to avoid that. Now, over the past 7 months, our FIRL Pro model portfolio has grown by 18%, while the market has fallen by 3%. Now, if you're interested in learning how we did it, we've got a special free training just for you on the 23rd of March. So go ahead and sign up in the comment section or the description. Okay, so this is probably the biggest story that the financial markets have thrown us this year globally. I could be wrong. Outside of maybe the Fed's, slowing down interest rates rising, but that's so boring. This is not boring, right? SVB Financial Group. So they are a bank, very unique. This is something you will rarely see in other countries, let alone Malaysia. But the US has a lot of smaller banks, a lot of regional banks. If you look at Malaysia, for example, we have only a handful of banks that pretty much dominate the place.
Less than 10.
Yeah, less than 10. And, maybe 3 or 4 really controls everything else, right? Maybank, Public Bank, CIMB, and maybe RHB,
yeah.
right? In the US, you do have the big banks like JP Morgan, Wells Fargo, Citibank,
Goldman Sachs.
BofA.
Yeah.
So Goldman is called more like investment bank. But But what's unique about the US, because it's so big, right? So you have a lot of regional banks that you probably never heard of. And, they can make pretty good investments. Now, one bank that is something like that, is very unique, is called SVB, Silicon Valley Bank. So Silicon Valley Bank is designed to provide banking services specifically for the tech industry.
Yes, exactly.
Right? So share with us in more detail what exactly they do.
Right. So for the viewers who thought that SVB Bank is an investment bank, actually it's not.
It's not. It's just like a normal bank.
Yeah, it's a normal bank. Exactly. It's a commercial bank for startups, specifically for startups.
Yeah.
And basically the industry that they support are your tech, like you mentioned, life science, venture capital, and also private equity firms. So if you look at the chart over here, this is the top clients, the total clients fund by their industries. So it's all very innovative industries. Requires a lot of funds to survive.
Yeah.
And these industries, they requires a lot of fund to spend on their R&D.
Yes.
So they need those money. And how does this SVB bank make money is actually just they earn interest arbitrage.
Yes.
Yeah, it's
like
very
any
simple.
bank, or just like any bank?
It's just like any bank. But this bank is they loan out to startups.
Yes.
Yeah, and they collect money from startups or whatsoever lah, or VCs or whatsoever. Yeah. So in 2022, they actually held about 198 billion worth of deposits. Means all of these customers, and also they have about 211 billion in assets. Now, this 211 billion in assets is this is the how they categorize it. About 82 billion, it is from mortgage-backed securities. And 83% of these MBS is actually residential properties. And then about 74 billion is direct loans. So 55% of these direct loans is loaned to VCs and PE. A very risky bet, actually. And it's a short-term bet some more. So and then the last one is basically just liquid asset, about 55 billion. Very small amount only.
Yes.
Yeah, so that is just a context for you to so that you know what does SVB Bank does. Yeah,
and of course their cost is just what they have to pay the depositors, right?
Yes,
which
exactly.
we'll talk about later on.
Yeah.
And I would imagine it's quite low for 2 reasons. One, of course, interest rates before 2022 was low. B, a lot of these companies will require more liquid cash, right?
Yes, exactly.
Because it's tech and they're burning money and all that. So most likely they have to put it in some sort of flexible account where the interest is lower.
Right. So this is what happened to the SVB collapse. But before that, I just want to show you guys the investment portfolio composition. Okay, I know this is very blur, but the top one is basically SVB. This one is JP Morgan and this one is Citibank. So why you want to know the differences in their investment portfolio, right? Because you notice that for SVB Bank, they are the top number one here in terms of securities invested from their asset. So about 87% of the asset that they held, which is the depositors' money, they use it to invest in somewhere else. And then this is basically their investment portfolio lah. And then you will notice that there's actually 64% is held in agency MBS, which is your mortgage-backed security. Now, if you notice like other firms, right, the benchmark of their investment in terms of putting inside the security is only like 20% to 30% ish.
Yes.
But for SVB, they very gung-ho. They put like basically like 80% of the money they just invested out.
Yeah, and MBSs are something very similar with what a lot of banks were buying in 2008.
Yes.
Right, and there's a promise of higher fixed yields, which we will talk about later on.
Yes, exactly. But anyway, we'll come back to this later. This is just to show you. I know it's very hard to see the data right now because I just got it from Twitter only. But yeah, so this is what went wrong. So about 57% of SVB's total asset, or 120 billion, is in their investment portfolio. And just like I mentioned, the average US bank is about 24%. 78% of that portfolio, or 93 billion, it is in MBS.
Yes. So this would be Q4 2022, right?
Yes, correct. And then Citibank and only JP Morgan, they have about 30% of their investors are inside this MBS, which is a very small amount. And this is the mistake that SVB did, which was they invested this 93 billion into a 10 years held to maturity MBS, and it is at a fixed rate of about 1.5%.
So they probably bought this before Jerome Powell started hiking rates, right?
Yes, exactly. So I think this one was in if I'm not mistaken, 2020-ish, 2021.
So somewhat in their defense, they probably felt like, well, if the interest rates are like what, 0.25% or 25 basis point, hey, if I can get 1.5%, right, that's like so much higher, right? That's at least, I don't know, 6 times higher.
Correct. Basically, they just didn't expect Jerome Powell to progressively increase the interest rate so fast.
Yes.
So that's why they are like so confident. You know what? 93 billion. I mean, what's the worst that can happen, right?
Yeah, and everyone pays their mortgages. Right.
Exactly. And then, okay, so this is what happens. Basically, the interest rate and the bond price has an inverse relationship.
Yeah.
So when interest rate goes up, the bond price that SVB bought will actually go down.
Yes.
Yeah. So I just need to know this fact. Why? Because back then they bought this bond price at a 93 billion. So this is their cost.
Yes.
Right. So when the interest rate went up from like 1% to as high as 4.5%, 5%.
25 basis points to right now almost 500 basis points.
Yes, exactly. Points, So this is what is happening to SVB's investment in their MBS.
Yeah. So just to go deeper on this, or to simplify this, right? Really what it is this, okay? People buy these bonds or these mortgage-backed securities because they think it's a better bet in terms of safety and returns, right? Mortgage-backed securities, if you assess what's inside the mortgages in these securities, right? Maybe just a refresher, mortgage-backed securities just basically, people taking different mortgages and then lumping them all together, because when they lump them all together, then they are supposedly safer. Of course, in 2008, they lump a lot of garbage together. So if you lump a lot of garbage together, you get garbage. Yeah. So I'm going to give them the benefit of doubt that the mortgage-backed securities here are all quite solid, right? They are all like, AAA, and they're pretty good. They're investment grade. And it's not, so anyway, they're investment grade. And doing that will give you that 1.5%, which is higher than what you would get, just buying either a bank or the supposedly safer kind of bond, which is T-bills or treasury bills. Right. So what happens when the interest rates go up is that now you can get, let's say, 4.5% at the bank, where your money is
Backed by the government.
Backed by government and more liquid.
Yes.
But remember, you you fix that returns that you get from the MBSs at 1.5%.
And 10 years.
So guess what? People are going to start dumping the mortgage-backed securities, right? And that's why roughly 17% of the MBS value has dropped. Now, it doesn't sound like much, but later on we'll show you why that's very significant. So yes, continue. 93 billion to 76.
Yeah. So basically just imagine that your portfolio, let's say you got 100,000 portfolio. Now it's like worth maybe around 83,000. Yeah.
Hey guys, if you're interested in building a 6 to 7 figure portfolio using the power of stock investing, head over to the comment section or the description to sign up for our free masterclass so that we share with you exactly how we do it.
So when they see that happen, right? So they're trying to like calm the customers down, like their investment, their money is all fine.
Yes.
So basically what they do is that they sold 21 billion of treasuries and agency bonds at a loss. So if you look at their investment portfolio over here, so about 14% of it is actually inside treasury. And then another one, it is the agency, I think it's this one. Also it's about 14%.
Yeah.
So those are kind of like a safer bet. But what they are doing is that they are selling off their safe bet to ensure customers that they have money inside the bank so that they can withdraw. So it was quite a desperate move, just to tell the customers that they have a safety net.
And mind you, now treasuries are giving quite a high percentage.
Yeah, exactly. So this is what happened. When the SVB announced that they sold the treasuries, and then they, just to say that they have a safety net in their bank, they have money inside the bank, basically everybody started to panic.
Yes.
Why? Because number one is that 96% of the deposit that's inside SVB, it is not insured by the FDIC. I won't explain what it is. It's basically just an insurance company.
Yeah, no. I mean, the equivalent in Malaysia is a PIDM.
Yeah.
Yeah, where they secure 250,000 ringgit. So in the US, FDIC secures 250,000 US dollars.
Yes, that's what that is
per account.
Yeah, that is when the bank starts to go insolvent. They cannot pay you. Then,
yes.
Then got a 200.
Or 90 other scenarios are where somehow the deposits are lost or whatever.
Yes.
However, I'm not sure if you put it here, the average deposit in SVB is 4 million US dollars.
Yeah.
Not 250,000.
Not 250. So
this 96% is around there, right?
Yeah, exactly. So basically, just to tell you that everybody thought that they're going to lose their money. Just put it, that's a very simple analogy. Okay, so this is what caused customers and depositors to be very scared of SVB because there's actually a series and episode of bad things happen in the past few months. So that's your FTX collapse.
Yeah.
A lot of the investors or even customers cannot get their money back. There's tech layoffs.
Yeah.
There's your Silvergate, the crypto bank that also collapsed, which is also related to FTX. Then there's your high interest rate environment, and also there's a potential recession that everybody is like screaming. So basically this is what happened. A lot of people went to the bank. That's why I see pictures or videos like people stand queuing up the bank branches, right? They're just trying to withdraw money. And about 16 billion USD is actually withdrew from SVB. And that actually left the SVB to have like a negative cash of like 1 billion.
Yes, that's right. Yes.
So they basically, just to tell you that their balance sheet is pretty much dried up already. They are
in Malaysia, they will be PN17. Right?
Yes, exactly. They will be in PN17. So yeah, it is actually a very bad situation that we are seeing bank run in 2023. Now, this is what is happening when there's a bank run. So because there's the depositors and the investors are depositors only, they are very desperate to get their money back because some of them, they need to pay their employees money or something like that. So this is where all the other hedge fund managers and all those big pockets come in. So what they came in and they say is that, hey, I can give you the money now, but you need to pay me 50 cents or 55 cents or 65 cents on the dollar that you put inside SVB. Yes. So basically, they're trying to like get money their money as soon as possible.
So basically, like your money is stuck in the bank.
Yeah.
You can't really get it out. But here I am telling you, okay, you've got 1,000 in the bank. how desperate are you to get it out?
Yeah,
I'll buy it for you for 50 cents
50
or 60 cents.
Yeah,
You want or
so
not?
yeah, so it's like 1,000 inside the bank. I give you 600 now. Take it or leave it.
Yes.
Something like that.
Now, if you are a depositor, you also have to ask, why is someone willing to do this?
Yeah, exactly. So later we tell you why lah. All right. But the bank run in SVB actually caused a lot of domino effect.
Mm-hmm.
The reason why there's a spillover effect because one, a lot of these companies that you see over here in the spreadsheet, these are all, some of them are listed companies. So for example, like Roku, about 26% of their, sorry, not 26%, but there's a portion of money inside their cash balances is actually deposited in SVB. So people think that, you know what, now they're in a very, very bad situation. So means you most likely the money is all going to be gone.
Yes.
So this one is basically just to tell you the spillover effect of other companies. And then the bank run also had affected other banks. So for example, like First Republic Bank, actually there's nothing going on with First Republic Bank. It's just like a victim because of this chaotic situation. So that actually caused another bank run in this bank. So there's actually a panic everywhere in the US. And so this is some of the lesson that we learned from this SVB collapse. So the more interesting thing that I didn't realize is that the US bank, there's this, I don't know what regulation is this or this rule.
They quite so bigger banks have
lesser.
Now they have they have to abide by the Basel Accords. So they need more equity buffer every time they have. I'm not sure the exact one, but there's this whole tier 1, tier 2 capital thing.
So tier 1 is more tighter regulation.
No. Okay, it's very complicated. Maybe one for another video. But basically, if you are bigger, then you have to abide by the Basel Accords where your equity needs to be buffed up. And that is why JP Morgan cannot do what SVB does and put 83% in mortgage-backed securities.
Yeah. Because of their asset, because SVB's asset is actually below this number.
And it's 200 billion, so it's so close, right?
Yeah, it's so close.
Billion, then they would trigger the...
And they also can actually play around the number. They can make their asset look like, below the 250. That's why they can put in 83% inside the MBS. So this is one of the rule which is very interesting that I didn't know also. And then the second thing that when you actually research about SVB is that they actually have zero hedge. Or actually there is some hedge, but it's only like 10% only. So it's a very small... Like there's no risk management inside to deal with this potential risk. And also there's a lot of accounting tricks. Maybe you want to explain to this. Like there's like the available for sales.
Yeah, so anyway, this part can be another video by itself, but the basic idea is that a lot of these things could have been identified actually like 2 quarters ago.
Yeah.
And the reason is because these assets were valued at cost. Like the 90, if I go back here, so you can see the 93 billion, right, or investment in this, what we call held to maturity assets.
Yes.
MBS was valued at cost because that's the accounting rule on the balance sheet. Now, what happens is that they actually put a bracket at the
bottom.
At the item. Right at the item itself, they say, but the market value now is 76 billion. So, 93 to 76. Okay, so it's not quite 93, it's probably closer to 91.
All right.
So 91, this Q4 2022, 91 to 76, that's 15 billion of equity loss, right? So then their shareholders' equity is roughly also about 15, 16 billion. And this was already available in like Q3 2022. You could see there already, right? And the equity would have been 1 billion. Let's say like a pretty bullish case scenario, 1 billion. But the liabilities are like 190 odd.
All right.
Okay.
Yep.
So, when, how do I put it? When I loan myself out, right? When I take a loan, right, for bank, let's say for house, right, usually the ratio, the debt to equity ratio for a house is maybe 1 to 10, right? 10% down payment. I mean, it's more complicated than that, but that's the basic idea, right?
Yeah.
So this is like the equivalent of like 1 to 200 that kind of thing, right? So your equity basically evaporates. But if it was not valued in the HTM method, which is value at cost, And if it was measured on the AFS method, it's called the
available for sales.
Available for sale, which basically means that when they list it on the balance sheet, it will be based on market value, and you will be reflected very quickly. Already.
Yes.
You can track the shareholders' equity suddenly drop in Q3. There's a lot to go into this, but this is why it's very important and why we talk a lot about all of this in our SIB programs and our FIRL Pro programs is that you need to be detailed when analyzing the financial statement of any company. And the balance sheet is especially important because there they can miscategorize assets or because of accounting rules, they're hiding in plain sight. It's literally that. I mean, I'm not sure if the snapshot, you put the snapshot here, but it was literally there. It's quite crazy. Like 91 billion, they said
then bracket,
the asset, then the bracket said, but our market value is 76. Then you look at the equity and it's like 16, 50 billion. Then you're like, wait, but it's there.
Yeah.
And you could have gotten this, even let's say you were late to the party, you could have gotten this 2 weeks before. So that's more on the accounting side of things.
Right. And then this is actually more important for banks, right? When you want to analyze banks.
This is actually important for all companies, but definitely for banks because the equity is usually very small relative to their liabilities. Because in most scenarios, let's say a manufacturing company or any company that's non-bank, liability is generally seen as negative. But in the case of a bank, it's not.
It's actually, it's a reverse.
No, it's a 50-50.
Oh, okay.
Right? It could be good, could be bad. And that's why it's more complicated. But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
Right. Okay. So that is the second lesson that we learned from this SVB collapse. And then the third one is that another potential thing that you could have foresee it is that the chief administrative officer is ex-Lehman Brothers CFO. I mean, if you know Lehman Brothers, then you know you know what's up. Okay, so the last one is whether there's a bailout. Okay, so initially these slides I did that during the weekend. So initially there was no news. And then
this morning.
Only this morning. So the Fed decided to bail out. And then they called this program the Bank Term Funding Program. So basically there's going to be like the Fed is going to come out. I think they're going to print the money. You
know what they should rename it to? They should rename it to Bank Term Funding Directory.
Oh.
BTFD.
Yeah.
But okay.
Anyway. But then, just TLDR for this one is basically they are going to bail out SVB.
Yeah.
And they are going to pump in as much liquidity as they need. Even though if they don't really have the money to pay off, they will still find ways to help them out. That's a very simple way of explaining this bailout. So yes, there is a bailout. Yay! Now everybody's happy again. But then this is just for the short term only. For the long term, I'm not so sure. Long term, I think it's gonna be.
I think there's an intense discussion now, right?
Yes.
Where they say, look, you can understand why in 2008 they bailed out the auto sector, they bailed out the insurance sector, they bailed out the banking sector. Right? And I'm not sure if the aviation as well, but the reason is because these guys hire a lot of people, and the people that will lose their jobs as a result of being retrenched from these sort of companies who have a huge widespread effect, there'll be mass unemployment and it'll be a Great Depression style event. Yeah. So people are saying the same thing about this, but remember, right, if you look at the client list that they have, right, the Roku, Roblox, you don't want people, obviously we don't like people to be unemployed, but let's think about it, right? If a bunch of coders or white collar workers at these tech companies get laid off, is that in any way comparable to, let's say, GM or Ford laying off hundreds of thousands of people, right? And so a lot of people are saying, well, you have to stop this contagion here. And maybe it will be a problem where there's a ripple effect. But again, this is a tech sector, right? The tech sector is like for rich people. And why not just let them fail? That's one side lah. So there's intense discussion going on now. My personal view is that I don't see, I could be wrong, let me know in the comments, but I just don't see how people losing their jobs at Roblox or Roku and things like that is really going to be hyper detrimental to a company.
Yeah, exactly.
People hired in these companies are very likely to be able to be hired in other companies because they are highly skilled and they're good. And you bailing them out now is kind of like either keeping their job or maybe even saving some of their employee stock options.
Yeah. Actually, this will bring in more problems in the future. Why? Because there will be more people like SVB who wants to become like them. Yeah. And then they are not worried about any risk.
Yeah, so that was exactly what the Citibanks and all that did, because they realized. So a lot of people don't know this about 2008. The problem actually started in 1985, somewhere in the 80s, on the savings and loan crisis. So the saving and loans crisis, or the SNL crisis, right, was when the US government actually stepped in to save a bank. I can't remember the exact bank. That was like under top 10. It's not even top 10, or maybe it's at the bottom half of top 10. So if you're a Citibank or that, if the government will save the small bank, definitely they're going to save me, right? So that's why those scenarios, it kind of makes sense for them to go in and stop the contagion risk. But this one, I'm not sure. I mean, it's just a lot of tech people losing money,
Yeah, exactly.
And they've made so much money over the past 10 years. I mean,
I mean, that's why
lose some,
that's why you see like there's a lot of comments or slogan going around: privatize profit, socialize losses.
Yeah, so but at least with the auto sector, like it kind of makes sense.
Yeah, that one makes sense. But this one is
it's like people. Then there'll be a lot of unemployed people in San Francisco, lah.
It's like what will these employees will get re-employed if, let's say, this thing goes to bust? I mean, their chances of getting back to re-employment is pretty high lah, because of the skills and everything. Yeah. So, but if let's say an auto sector, then they lose their job because of that, then nobody save them.
All your life you fix cars now. What can you do?
Yeah, exactly. So
these are like coders, these are like admin staff, I don't know, accountants, customer service. You can definitely find a job outside.
Yeah, exactly. So that's the sad part. Yeah, that's gonna be a bailout. But before you guys go, just to share with you guys about FIRL Pro. So this is our stock performance so far for the February. So far it's been doing pretty well. I believe there's a redness in the market, so some of these stocks the gains are actually shrinking a bit, but it's still in the green. And then if you notice that at the bottom there is a Telegram stock portfolio. So basically that is what
we discussed, right?
Basically this is a short portfolio for short term. If you want like a quick gain for short-term catalysts, then you can check out. This is how the portfolio has been doing. So far it has been doing pretty great. And if you're not convinced about FIRL Pro, you need more information about our performance and how we write our reports.
Free sample.
Yes, we got a free sample. The links are in the description and comments. And also, don't forget, we got a Masterclass coming soon, which is on the 23rd of March. Basically to tell you guys how we actually profit from a 2023 recession using the FIRL Pro method. So if you're interested to know more about the Masterclass, do check out the sign up links. They are in the description and comments down below. And that's it for today's video. MJ, any last words?
I mean, the seats are running out, right? We have a Zoom limit. So quickly sign up. And guys, thanks for staying all the way until the end. Come watch some of our other videos. And I'll see you in the next video.